Hi everyone, very good afternoon and welcome back to CGB Mentors. Let us start the marathon. In this particular class, we will be discussing the questions of module D, that is on balance sheet management, right. So, let us quickly start discussing about it. Let us see question number 1, that is, which of the following will not be found under other liabilities and provisions in a bank's balance sheet? Not be found. Inter-office credit adjustment, provisions for income tax, overdue deposits, interest accrued but not due on borrowings. So, overdue deposit is something that you will not found over here because it is a type of deposit liability, not part of other liabilities. In the other liabilities, you will see the items like bills payable, inter-office adjustment, interest accrued, tax provisions, etc. right. So, when you have a specific head, go for that particular head. Now, next is which of the following is considered a contingent liability on a bank's balance sheet. So, whenever we are talking about a contingent liability, that means its future is not clear today, but it will be clear tomorrow. That means once any uncertain event happens, right. So, till then it would be called as an contingent liability. So, that is why over here the correct option would be letter of credit issued on behalf of customer, because we do not know that whether the bank would be called upon to pay for this or not, right. So, letter of credit, bank guarantees, acceptance, forward contracts, these are the classic examples of contingent liabilities. Next, we have a bank's investment in government security is primarily done to comply with which of the regulatory requirements? So, obviously statutory liquidity ratio. That is why the banks invest in the government securities. So, banks are required to maintain a certain percentage of their NDTL, that is net demand in time liabilities, for example the deposits, in the form of liquid assets, because any time the customer can come for asking its deposits, right. So, that is the question. Now, next is which of the following asset item reflect the most liquid position of the bank. So, out of these the most liquid one is cash and balances with RBI, right. So, cash and balances with RBI is the most liquid asset. It includes cash in hand, balances with RBI, right. So, this is the balance sheet head of the bank, right. In that cash in hand is also included, balances with RBI is also included. So, that is why it would be called as the most liquid option. Now, which of the following expense would typically be shown under the operating expense in a bank's or in the bank's P&L account? So, over here operating expense, interest paid on term deposit, provisions made for NPAs, depreciation on leasehold property, interest paid on borrowings from RBI, right. So, over here see this interest expenses that would fall under interest expended, right. Provision for NPAs would be part of provisions and contingencies. Operating expenses, depreciation on bank's assets, this would be under the label of operating expenses, and that is why option C is a correct option. Now, next we have which of the following is not a valid component under provisions and contingencies in a bank's P&L statement. Not a valid component. See, under provisions and contingencies, rest of the other they are provisions, but the taxes paid in advance, that does not come under the provisions and contingencies. So, that is why we will not include it. Tax paid in advance, it is not an expense, but it is an asset, and hence it will be shown under other assets. What provisions and contingencies in general include? Provision for NPA, any diminution in the investment value, transfer to contingency reserve. So, all these will be included in provisions and contingencies. Now, under interest income, which of the following would be excluded from the head and shown elsewhere, right? What would be excluded over here? So, interest on saving deposit obviously would come under the. Now, interest on interbank call money placement, income from foreign exchange commission, discount on export, bills purchased, right. So, what would be excluded over here? See, ABD, they are all interest income items except A is interest paid, so not income at all. B is interest received on interbank funds. D is also discount on advance, so it is an interest income. So, foreign exchange commission, this would come under profit on exchange transaction, which is a part of other income, but not in the interest income. One thing over here is, see, over here which would be excluded, you can take A also, right? आप यहाँ पे A भी ले सकते हैं in general, reason being that is the most outlier one, right? यहाँ पे सबसे ज़्यादा outlier A ही है, so it would not be C because that is in a way income also, so interest on saving deposit is something that you should exclude. Now, which of the following best defines the core objective of asset liability management? Why do we what is asset liability management? Basically, hear me out very carefully. So, when you are a bank, you want to earn on your assets and you also want to pay on your liabilities, right? So, you have to manage in such a way that income from your assets should be higher than the what you pay on your liabilities. जो अपनी liabilities में pay करते हैं वो कम होना चाहिए, जबकि आपकी assets पे जो आप earn करते हैं वो ज़्यादा होना चाहिए. So over here the correct definition or a core objective of asset liability management would be managing the interest margin while balancing the profitability and risk, right? That is our major objective under asset liability management. Now, a bank has 60% of its liabilities maturing in the next 6 months, while only 20% of its assets mature in the same period. That means you will have to pay more for your liabilities, a clear indicator of asset liability mismatch. Now, what specific risk does this scenario reflect under ALM? If you remember, we have done this yesterday as well. Credit risk, refinancing risk, liquidity risk, reinvestment risk. So over here the bank is facing the liquidity crunch because the liabilities are going to mature really sooner as compared to the assets. So that is why it is a liquidity risk and it's a classic ALM mismatch situation. Now, which of the following developments contributed significantly to the growing importance of ALM in banks? So, reduction in CRR, nationalization of bank, deregulation and volatility in the interest rate structure, increase in the branch network. So, basically over here why the asset liability management has come to the forefront. Number one, when we have talked about it, asset liability mismanagement, we have linked it with your net interest margin. ठीक है, आपके net interest margin के साथ में link किया गया है, and that is why as and when the deregulation and happened in the interest rate structure post 2016, that has been the cause of the asset liability mismanagement, you can say that. Now, what is meant by the balance sheet restructuring? Balance sheet restructuring का मतलब होता है adjusting the asset and the liability portfolios to meet interest rates and the liquidity objectives, right? So, this is what called as a balance sheet restructuring. See this, actively managing and realigning your assets and liabilities based on what is your liquidity position, what is your future interest rate expectation. So, these are very important few points which is taken into consideration while restructuring your balance sheet. Restructuring balance sheet means reduction in some kind of liabilities, right? Increase in some kind of assets, increasing your investments, etc., etc. Now, next we have in asset liability management the term price matching. It means maintaining the spread by deploying the liabilities at higher rates than the cost. Over here I am again mentioning it. See, price matching का मतलब positive spread maintain करना between the return of assets and the cost of liabilities. So, if a bank is using low cost deposit to finance high interest loans to maximize profitability while also managing the risk arising from the interest rate movements. Now, what is the correct formula for the NIM and what does it indicate? So, obviously in the NIM what you want to measure is net interest income divided by average total assets, right? That is your net interest margin. It indicates the earning spread that you are having, that means what you are receiving versus what you are paying, right? Now, next you have which of the following ALM objective is correctly matched with its impact. So, over here economic equity ratio, it is something which measures sustenance capacity via own funds, right? So, what is your own funds that you have deployed in the business? This is going to give you sustenance over a long period of time. This is what we are trying to measure in the economic equity ratio, right? Net interest margin, net interest income, right? Economic equity ratio, separate kind of things. So, over here economic equity ratio, the formula is going to be shareholders fund divided by total assets. So, it is not only about the short term profitability, right? Economic equity ratio tells you about the long term stability, right? And over here it has what you can say reversed the In net interest margin measures the spread which is there in comparison to total assets, whereas net interest income indicates ability to withstand the market volatility. That means the amount of spread that you are having. Okay. Now at the micro level, what are the dual objectives of the ALM in banks financial operations? So dual objective is obviously maintaining the profitability as well as the liquidity. These are the twin objectives of asset liability management. Now under pillar 2 of the Basel III framework, the banks are required to undertake an ICAP. What is the primary objective of this internal process? I would like to tell you. So the primary objective is obviously to assess and maintain adequate capital, not fully captured, but you have to understand this. ICAP is internal capital adequacy assessment process. It's a key feature of pillar 2, and now what it requires is, it wants the bank to internally assess all kinds of risk like liquidity, concentration, settlement, strategic, reputational, climate risk, etc., and hold the additional capital accordingly. It tells the bank that you should do the analysis of all such risk, and as per, see, all these risks are going to differ bank to bank. So as per your own requirements, you should hold the additional capital, because pillar 1 covers only credit, market and operational risk. Pillar 2 goes beyond those risk scope. You also have to remember that what are the risks that are covered by the pillar 2 of your Basel norms, right. So which of the following correctly matches the 3 pillars of the Basel III with their key purposes? So over here, pillar 1 is minimum capital, pillar 2 talks about supervisory review process, and pillar 3 is about the market discipline. Remember that, minimum capital, supervisory review and market discipline. Next, under the Basel III pillar 2 framework, what is the key responsibility of the bank's board of directors with respect to the ICAP? So over here, board of directors has to ensure that the ICAP forms an integral part of bank's management and decision making culture. It's not just a compliance document, but you have to assess all the different kind of risk which has not been covered in the pillar 1, and the responsibility goes on to the board of directors. So they have got the ultimate responsibility to structure, design and implement the ICAP. Now, which of the following risk is not explicitly covered under the pillar 1 of Basel but required to be assessed under pillar 2? So over here, if you will see the interest rate risk in the banking book, right, this is not explicitly covered under the pillar 1. Under pillar 1, it only talks about the operational risk, market risk and credit risk. Remember that, operational risk, credit risk and market risk. The interest rate risk in the banking book, right, and all these kind of risks, these are not covered, right, and they are included in the pillar 2 of the ICAP. Right, we have the RBI guidelines on this as well, so we will have a look onto it. Now, which of the following statement correctly describes the purpose of using external credit rating agencies under the standardized approach to the credit risk? See, it is very viable, because to determine the risk weights which are assigned to the various exposure based on credit worthiness. See, under the standardized approach, external credit assessments is done so that we can assign the risk weights to the different exposure. This helps in determining the capital requirement based on the credit worthiness of the counterparty. And because the external credit rating agencies are going to provide you an independent view, right? They are going to provide you an independent view. So this is why this is very important. Now, in the context of credit risk mitigation, which of the following is considered as an eligible financial collateral under Basel guidelines for capital relief? So that is gold and government security. Why? Under Basel norms and RBI guidelines, eligible financial collaterals, they include high quality liquid assets such as gold, government securities, corporate bonds. These collaterals can be used to reduce the credit exposure after applying the appropriate haircuts. That means in order to be more prudently viable, right, that is why haircuts would be allocated onto that. But still, even after applying the haircuts, these instruments remain quite sturdy in protecting you from any kinds of risk that might come to your way, right. Now, in the context of interest rate risk in the banking book, what is the impact of upward interest rate shock on the bank's economic value, assuming all other factors they remain constant? So over here, see, interest rate risk, impact of upward rate shock. So it generally leads to decline in the economic value of asset. Obviously, if there would be upward interest rate shock, right? They are talking about that your margin or the spread is reducing. So what impact it can bring on to me? It will lead to decline in the economic value of my assets. See this? An upward rate shock, it generally reduces economic value of my fixed rate assets because the future cash flows are discounted at a higher rate, right? But banks are also required to disclose the impact on earnings and economic value due to such shock as part of your interest rate risk in the banking book related disclosures, right? Now, next is, which of the following loan accounts should be immediately classified as loss assets? So over here, from here we will start talking about the IRAC norms, right? Income recognition, provisioning related norms. So over here, which one should be classified as a loss asset immediately? So wherever the realizable value of the security is less the 10% of the outstanding amount, this is something clearly your loss asset, because you will not be able to realize anything. Right, so as per RBI guidelines, the realizable value of security, if it is less than 10% of the outstanding amount, the existence of the security, even if the security is there, it is not covering anything. It is merely covering anything. So that is why we will consider it as a loss asset. If the erosion is between 10 to 50% of the value of the collateral, it would be classified as doubtful asset. Now, a term loan is said to be an NPA when the interest or principal remains overdue for the period of more than 90 days. 90 दिन से ज़्यादा के लिए अगर ये overdue रहता है तो, right? And before 90 days, it would be classified as an SMA. Now, as per RBI guidelines, which of the following is a valid reason for classifying a cash credit as out of order? So, in this particular case, see this, interest is not serviced and credits are not sufficient to cover debited interest over the period of 90 days. So, then the cash credit overdraft account would be classified as the out of order. ठीक है, तब हम इसको क्या बोलेंगे? Out of order. Now, a bank has sanctioned a project loan to an infrastructure company. As on June 2023, it was the date of commencement of operations. The project has not commenced commercial operations till July 2025. However, all dues are being paid. But still, this would be called as a non-performing asset. See, over here it has been said that the projects we are going to divide into two parts. One is infrastructure, one is non-infrastructure. In case of infrastructure, whatever date of commencement of operations you have given, you have to start within 2 years. Right? If you haven't started within 2 years, your account or your loan would be classified as an NPA even though you are regular with the EMI payment. ठीक है? Because you have been unable to fulfill your requirements. ठीक है? आप अपनी requirements को fulfill नहीं कर पाए हैं. So that is the reason. For non-infrastructure loans, the limit is 1 year. Now the bank has a loan account which has remained in the doubtful category for 2 years. The loan is secured. So what is going to be the minimum provisioning requirement? 40%. Right, over here they have said that if the asset remains doubtful up to 1 year, 25%, more than 1 year but up to 3 years, 40%, and if more than 3 years, then it would be taken as 100% provisioning required. As per RBI guidelines, what should be the ideal provisioning coverage ratio? It should be at least 70%. Bank should be having the provisioning coverage ratio at least 70%. Provision coverage ratio formula, what are your provisions divided by your gross NPAs? That means the loan accounts that has become bad, right? Next is, a borrower is reported in default by the lender as per RBI prudential framework within 30 days, right? So they have to conduct a review of the borrower's account within a period of 30 days and we call it as a review period. Now, a restructured MSME account has aggregate exposure of 20 crore when it can be upgraded to standard classification. So suppose you were paying a loan but you are unable to pay it, so you ask the bank to restructure it. So once the restructuring is done, first, for the next 1 year, you have to pay your EMI as well. If you have paid your EMI as well, then we'll classify you as a standard account, right? So for MSME with exposure less than 25 crore to upgrade to the standard, a specified period of 1 year must pass from the date of first payment. During this time, no payment should remain overdue for a period of more than 30 days. So we can convert the account into a standard account only once after 1 year of satisfactory performance. Now, company has an unhedged foreign currency exposure where the estimated likely loss as percentage of EBID is 45%. So, what is the incremental provisioning requirement for the bank? See this? For unhedged foreign currency exposure, unhedged means you have not taken a counter position to save yourself. In this case, this is your likely loss and this is the incremental provisioning you have to do, right. Since the exposure is 45%, so the provisioning is going to be the 60 basis points, right. This is the incremental provisioning. Now, an NPA loan of 10 lakhs is guaranteed by CGTMSE. The value of security is 1.5 lakh and CGTMSE cover is 75%. Now, what is the total provisioning requirement if loan has been in the doubtful category over 2 years? See this is a very important question. Outstanding balance is 10 lakhs, security value 1.5, so unsecured portion is 8.5. So, CGTMSE cover is 75% of your unsecured, that is 6.375 lakh. What is the uncovered unsecured portion? That is 2.212 lakh. So, for secured portion 40% provisioning, right, unsecured portion 100% and total provision would be made at 2.72 lakhs. ये आपका total provision बनेगा. Whatever is CGTMSE cover, you don't have to make anything for that. Now, a standard asset belongs to a company whose director appears more than once in the list of willful defaulters. Now, what is the minimum provisioning requirement for such a standard account? It is going to be 5%, right. So, if as per the RBI guideline, if the company's director appear more than once in the list of willful defaulters, the bank must provision 5% of existing loan exposure even if the account is standard, right. So, 5% आपको provision बनाना ही पड़ेगा. Which of the following statements regarding income recognition on NPA is incorrect, right. So, over here you cannot recognize the income on NPAs on accrual basis because it has to be recognized on cash basis. As and when you receive the income, then you have to recognize your income. Next is, as per RBI norm for resolving credit facilities like cash credit, an account is classified as SMA2 when the outstanding balance exceeds sanction limit continuously for more than 60 days but up to 90 days. Up to 30 days SMA0, then up to 60 days SMA1 and after that up to 90 days it is going to be SMA2. Special mention account. Now, as per RBI, what is the standard asset provisioning requirement for housing loans at teaser rate due to higher credit risk? So, it is going to be 2%, right. RBI mandates 2% provisioning on such loans instead of the usual 0.4%. Reason being, the teaser rate housing loans, they offer low interest rate initially but higher interest rate later, and that is why there is a higher risk of repayment related issue, because later on the interest rate increases and it becomes difficult for the borrower to pay. Now, which of the following statement is true with respect to stock approach to liquidity measurement? Stock approach to liquidity management, hear this out over here. Under the stock approach, the liquidity is assessed based on certain ratios on a given date. So, core deposits are stable and reliable, thus a higher core deposit to total asset ratio, this will indicate more stable funding. We have done this yesterday as well, so remember this. Right. In the flow approach to liquidity risk measurement, how we can utilize, which following tool is used to analyze the net funding requirement. So, over here we can use structural liquidity gap report. How? The flow approach focuses on how liquidity changes over time rather than at a point. So, it uses the gap method, which involves arranging the assets in time buckets based on residual maturity, calculating cumulative net cash flow gap, and this is operationalized through structured liquidity gap, right. So, LCR is a the other options also have been optimized over here. CCB is capital buffer, risk weighted asset is a part of credit risk, LCR is a regulatory requirement, it is not a flow tool. So, we are left with the option of structural liquidity gap report. Now, a bank's 3-month bucket shows 500 crore of interest sensitive assets of and 650 crore of interest sensitive liability. Now, if we expect that the interest rate is expected to rise by 1%, assume repo rate we are increasing by 1%. So, what would be the most appropriate conclusion? Now 500 crore worth of assets, 650 crore worth of liabilities. Over here you have got more liabilities, so the bank has a negative gap and it is going to suffer decrease in net interest income. Why? Because the liabilities are more, obviously, clearly. Now which of the following most accurately reflects the concept of modified duration? Have taught you yesterday also. Modified duration estimates the percentage change in value due to small change in the interest rate. You can also write yield in this place, right? So that is what modified duration is. It estimates that what is the change in the asset pricing by the 1% change in the interest rate or the yield, right? Now which of the following is true about dynamic simulation approaches? So over here it incorporates projected changes in business volume, customer behavior and interest rate strategies. Basically simulation is a concept that tries to see that what happens in the different kind of scenarios with changes in different variables. So it tries to simulate an environment, create an environment, and then tries to see that the what result is going to come. So yes, dynamic simulation goes beyond the current balances, includes assumptions about future business, rate changes, customer actions and reinvestment strategies. Now which of the following is a limitation of simulation based interest rate risk measurement model? क्या limitation है? Because they risk become overly complex black boxes, right? Over here you have taken so many assumptions that now it's not clear that okay, see, if I am making one decision and there are 10 assumptions involved, so it automatically becomes a black box for me, right? Because I am no longer able to take a clear decision. The decision is based on assumptions, right? Now which of the following scenarios best illustrates option risk component of interest rate risk? See, over here this is called as embedded option. So over suppose you have given a loan and there is a prepayment facility also, that if you want you can do a prepayment by paying a penalty of 2%. Now if suppose somebody pays that, then obviously this is an embedded option risk for the bank. Now as per the governance guidelines under the interest rate risk in the banking book circular, which of the following responsibilities cannot be delegated by the board of director to asset liability committee? See, board of directors, they hold the ultimate accountability for managing interest rate risk. While the asset liability committee may monitor the limits, strategic oversight would remain the board function and final accountability for the interest rate risk cannot be delegated to the ELCO, that is asset liability committee. Now which of the following scenarios best illustrate a case of embedded behavioral option risk? So if a saving bank account where depositors can withdraw funds at any time, this is obviously an embedded option risk, because savings bank account gives you the option to withdraw at any point of time. So this is the facility that you have given to your customer, right? Which of the following best describes the concept of basis risk in the interest rate risk? Basis risk क्या होता है? Risk due to different instruments with similar tenors being priced using different reference rates. Different instruments, same tenor, they are priced using different reference rate. For example, you could have used MCLR, another has used treasury yield, some other you has used repo rate related yield, right? So this is basis risk. Now what is the main purpose of stress testing for the interest rate risk in the banking book? So we want to see how changes in the interest rate may affect the bank's capital. This is why stress testing is done. Next is which one of the following is not a part of model validation as per the RBI guideline for the interest rate related in the banking book. So over here advertising the model on the bank's website, it's not, right? So model validation for interest rate risk in banking book includes checking methods, performing, monitoring, conducting, back testing, but advertising it's just out of the scope. And as per the RBI, when a bank is called an outlier in interest rate risk in the banking book, so when it falls, its value, economic value of equity is more than 15% of its tier 1 capital under interest rate stress. So if there has been stress in the interest rate and the value of equity of the banks falls more than 15% of tier 1 capital, it would be called as an outlier. So, these are the questions that we had to do in your module 2, right, in your module 4, sorry, that is balance sheet management of your paper 2, that is BFM. Thank you so much for joining in.